Hello people, so let's quickly review RTP Jan 2026 of our financial reporting paper. Overall good RTP. So there's some new questions which has been introduced over here, so we will cover them. If it's a repetitive one, we'll not be doing that, only the new questions we'll be covering over here. Okay, alright, without further delay, so let's get started with this party. Okay, they've given the case, so it's always worth to read the requirements first and then go back. So something about lease term they're asking, lease liability they're asking initially, ROU ka value they're asking, and ROU should be depreciated, right? So they're asking about depre of that, and something about deferred tax. So that's the requirement of this particular case study. Okay, so basically lease and deferred tax ka case this is. Okay, so with that in mind, let's read the case. Now, X Limited is a lessee. They've entered into an agreement with the lessor, that is Y, and the initial period called out is 10 years. But you also have an option to extend this lease for 5 years. Now, what will be the lease term? Sir, that depends on what? If lessee is reasonably certain that they will go for renewal option, they'll exercise or utilize this renewal option, then the lease term will be 10 plus 5, which is 15 years. If lessee feels no, they will not go for renewal option, then the lease term will be 10. So here what they're saying, at the commencement date, X Limited, that is lessee, is not reasonably certain to extend the lease. That means answer we've already got. Lease term is what? 10 years. So the first requirement ka answer we already got. Lease term here will be 10 years. Okay, because lessee doesn't want to, is not reasonably certain to renew it. Okay, lease payments are 50,000 during initial term and 55 during optional period. This is irrelevant because optional period means renewal period. Since we are not, lessee is not sure about renewal, so that 55 becomes irrelevant for our calculations. Lease payments are required to be paid at the beginning of the year. Keep this in mind. We find out present value. So whenever you're finding present value calculations, payment date becomes important. They will say either payments are made in arrears. Arrears means at the end of the year. Here they're saying the payments have to be made at the beginning of the year. So keep that in mind. To obtain the lease, X Limited lessee is incurred some initial direct cost, IDC of 20,000. IDC we adjusted with ROU, correct? It's like a DAC. We adjusted with ROU, of which 15,000 relates to payment of former tenant occupying the floor, 5,000 relates to commission for real estate. So we paid a total IDC of 20. Breakup we don't required. As an incentive to X Limited for entering the lease, Y Limited agrees to reimburse 5,000. So that means what, sir? Though you have spent 20, 5 you will get back. So the net IDC cost is only 15,000. So only 15,000 needed to be add 15,000 we need to add to the cost of ROU. Okay, IRR is not given, so we took incremental borrowing rate of 10%. Fair enough. They're saying 2 decimal point. This is about deferred tax. Okay, so they're asking you lease liability ka value and ROU ka value initially and depre ka value. That's it. So how do you find out, sir? ROU, there is no measurement basis. Initially, lease liability is measured at present value of future cash flows, discounted at IRR first preference. IRR not there, we take incremental borrowing rate. But keep in mind, here lease payments are at the beginning. Either you can put up a table, the payment will start from year 0, or common sense, 50,000 immediately you'll have to pay. So it's already on present value terms. Other than 50,000, 10 years lease term, no, one payment you'll have to make now. 9 payments, balance 9 payment you'll have to make over 9 years. So calculate like this, that's much easier. So 50,000 you'll have to make over 9 years, right? So find out same payment. So find out PVAF at 10% for 9 years, not 10 years, because one payment you have to make immediately. So remaining is 9. So 9 years ka PVAF you find out and multiply. The 50,000 payment you'll have to make now only, it's already on present value terms. Adding this, you'll get the lease liability ka value. If you don't like this, put up a table. 10 rows you need to have. Year, column, 0, 1, 2, 3, 4, 5, 6, 7, 8, 9 like that. And then discount factor, multiply, and you'll get present value. I suggest this faster. I mean, it's faster, so. Alright. So that means what will be the value of lease liability? 3,37,500. But hang on. This may be the value of lease liability, but immediately on day 1 you will pay 50,000. No? That means the value of lease liability is not 337,500. Okay. In fact, this is the value of lease liability and ROU. So you will pass the entry ROU account debit to lease liability. Correct? But on the same day, you'll have to also make a lease payment of 50,000. So lease liability balance will be 337,500 minus 50,000, which is 287,500. If you remember, we used to tell in our class, whenever the payments, lease payments are done at the beginning of the year, you'll have to change your ACM table format slightly. Year, opening balance, payment, revised opening balance or revised balance. On the revised balance, calculate finance charges. Adding these two, you'll get closing balance. If you remember, we have done such questions. Just for your reference, I've got this. Okay, so LL balance will not be 337. Since you paid off 50 immediately, LL balance will be 287,500. That's what they asked. What is the LL balance? 287,500. Similarly, they asked what is ROU balance. ROU balance initially you have recognized as 337,500. Okay, or maybe there is IDC also. No, hang on. So 337,500 is the value, but there is initial direct cost. Spent 20,000, reimbursed 5,000. Okay, that means net it's only 15, or you can show both. 337,500 as we got here plus 20 minus 5. So 350 to 500 will be the net ROU cost on the day one. That is the option. Now they have asked ROU ka depreciation. Since the lease term is 10 years, you'll depreciate over 10 years. 350 to 500 over 10 years if you do. 35 to 50 is a depreciation every year you'll book. That's a pretty straightforward question. Okay, yeah. Next, they have given case on deferred tax asset. X Limited has DTA recognized in balance sheet with respect to unused tax losses, carry forward losses there. On that you create DTA. No, income tax rate to calculate DTA, we used income tax rate of 40. Okay, a new government has come to power on 1st April. Sir, we are doing all this on 31st March 20x2. Okay, fair enough. So now new government has come after the current year ended. In fact, they showed here only. Yeah, after the current year ended, new government came on the next year ka first day. They came into power and they passed a legislation that approval, Lok Sabha, Rajya Sabha, everything drama happened on 17th April. What drama happened? The new tax rate was taken as 33%. From 40 they made it to 33. Now the question is, to recognize DTA, will you take 40 or 33? Sir, to recognize DTA, DTL, you take enacted tax rate or substantively enacted tax rate, right? Enacted means published. Substantively enacted means more or less published. Here, as of at the end of current year, government was not there in power, nor the publishing was there. So hence this 33% tax rate is not substantively enacted, nor it is enacted. So 40% only is what the tax rate we will take to create the DTA. That's a question. Okay, that's it. Right, next case study. There's about Ind AS 115 revenue recognition. A Limited enters into a 3-year contract to provide 1,000 hours of standard call center operator time per annum. So we are giving a service. We are giving, someone has outsourced call center work to us. We will probably hire the employees and give 1,000 hours ka call center work. Okay, for 6 lakh rupees, 2 lakh per year. Every year 2 lakh for 3 years. Okay. Now, if you observe, right, sir, you are giving what, sir? Service over 3 years, right? But first year service is separate from second year service. Yes, no. The moment we give 1 year service to our customer automatically will get the benefit. Sorry, that means each one is separate over here. Okay, fair enough. All right. So 2 lakh per annum is what we are charging, and totally we are charging 6 lakh. Standalone, yeah. At the end of first year, the contract is extended for another 3 years. After 1 year over, we thought we'll extend it for another 3 years. Okay. In accordance with some terms have been agreed upon. In accordance with the contractual provision for the fee in first year is reduced by 90 due to some defective service. First year we did not give the right kind of service. So instead of 2 lakh, client told I will reduce 90. Okay, fine. That is one. The contract is extended for another 3 years for 7,50,000 is what they have told. So it is not 3 years now. It is 3 plus 3, totally 6 years contract. And this extension period may year 4, year 5, year 6, we will get 7.5 lakh, 2,50,000 per year. Standalone selling price is 230. Okay, this is one. What is the question? They are asking first year how much revenue. What will you do for this modification and all? You have done extension, no? So it's a contract modification. How should we account it? So first of all, this contract modification, you cannot treat it as a new contract. You have initially it was 3, now you extended by 3 more years, right? So you have done a modification. The term has been increased. You can't treat this modification as a new contract because we have learnt. For you to treat it as a new contract, a new goods or service should have been coming. Here no new goods or services come in. So you cannot treat it as a new contract, right? Okay, that is one. And first year ka, if you have already given a service to the customer has already received the benefit, right? So whatever revenue you have recognized in first year, that should not be touched upon. Meaning, like here, first year, how much this modification, you normally whenever you do modification, we do some cumulative catch-up accounting, if you remember. Meaning revenue previously, whatever you have recognized, that you will adjust, that you will change, right? You will revise that. That's what we mean by cumulative catch-up accounting. But here, since first year service is separate from second year, they are all distinct service, right? Because the moment you give 1 year service to the customer would have already got that call center service ka benefit. So hence, whatever revenue you have recognized previously, do not adjust that. Meaning this adjustments will be done on a prospective basis. So whatever adjustment you need to do it from now onwards. Whatever recognized revenue we have already recognized, no need to touch that. Fine. Now, first year, what is the revenue? 2 lakh. But will we get 2 lakh? No. Due to faulty work, customer is saying, I will reduce 90. So there is certainty in collection only for 110. So first year, you will recognize revenue only for 1,10,000. 2 lakh minus 90, which is 1,10,000. That is one. Okay. You have done a modification. Will you do retro accounting? No, you will do it prospectively. From now onwards, in future, whatever revenue is there, that you will adjust. How? Very simple. So I have given a breakup over here. Firstly, how it was? First 3 years, revenue was 2 lakh. Okay. Year 4, year 5, year 6, the revenue is 2.5 lakh per annum. That's what they have given. Yes, no. Since first year service is already given, this revenue we cannot adjust. We can't book 2 lakh because customer is saying 90 I will not give because you have done a faulty work. So recovery is only 110. So we will book a revenue of 110. Okay. Going forward, how we'll book is this service anyway similar. Na? It's not like any new service you're going to give. Service, second year service, what you give is more or less going to be similar to third year service also. So how you will have to recognize is, now these are the revenue which these are the amount which you are yet to receive. Yeah, add them up. 2 lakh plus 2 lakh plus this if you add, you will get 11,50,000. So you still have to recover 11.5 lakh from the customer. And what is the period remaining? Year 2, 3, 4, 5, 6. 5 years is still remaining. So 11,50,000 will be apportioned among 5 years and you will recognize 2,30,000 every year. That's all it is. So that's how we mean by adjustment over here. Okay. So whatever revenue you booked previously need not be adjusted because it is a separate service, right? That's the reason we'll not touch that. So the remaining, how much ever amount you have to receive from the customer, that will be apportioned over the remaining period. So amount yet to be received is this much, which is 11.5 lakh. Period remaining is 5 years. So 1150 will be recognized over 5 years. So 2,30,000 will be recognized as revenue from year 2 to year 6. That is a question. So how will you do this modification accounting? We don't do it retro, we do it prospectively. Okay, that is option A for alpha, right option. Second, what is the remaining total revenue for 5 years? They're saying, what is the total remaining revenue? The total remaining revenue we have to recognize is 11.5 lakh. And each year, 230. Total revenue is 11.5 lakh. From year 2 to year 6, we'll recognize 2,30,000. That's what we got here. Na? Yeah, that is the amount. That's all. Not much of calculation, but you just need to be a little clear on the concepts. That's it. Okay. Yeah, this is about this case. This case has another part. Government G has significant influence over L. Okay, government G has significant influence over L. Okay, L has significant influence over A and it also control K. L has significant influence over A and it also control K. This is the chart. Okay. Now people, are these two related party? Yeah, if you have significant influence, you become related party. These two are related party. Are these two related party? Yes, significant influence is there. Are these two related party? Yeah, holding subsidiary, control is there, related party, correct. Are these two related party? Arrow approach. One side of the downward arrow, if it is control or joint control. Other side could be control, joint control, significant influence or KMP. These two will become related party. So these two are also related party. Okay. Okay, this is sorted. Sir, is G limited and K limited related party? Yeah, G ka associate is L. If associate has any subsidiary company, right, then this subsidiary and this reporting entity, these two will become related party. So G and K will become related party. But if associate has another associate, then this and this will not become related party. G and A limited will not become related party. That's what I've written. Okay, fine. We got the structure. What are they asking? Okay, they are saying which of the following statement is correct. They are saying, transaction between A and K are not disclosable. Sir, A and K are related party. So if there is any transaction, you have to disclose. So that is not the right option. They are saying A and L ka transactions are not disclosable. A and L are related party. So if there is any transaction, you have to disclose. So this is not the right option. We need to find the Satya Vachana, correct statement. This is a Sullu Vachana, wrong statement. They are saying A and K transactions are not disclosable. A and K, sir, A and K are related party. You need to disclose. Again, this is not the one. So 3, if you have eliminated, means the D for Delhi is obviously right option. A and L, A and K transactions are disclosable. Yes. A and L are related party. You need to disclose. A and K are also related party. You need to disclose. Hence D for Delhi. Right option. Okay. All right. Now, people, as I told you, like almost if we are doing any questions in RTP, keep that as LDR. That's much better to be on the safer side, right? All right. This is one good question I would say that has come out of this particular RTP. Ind AS 102. Of late, we are seeing a lot of new types of questions being added in Ind AS 102. I don't know ICI why our mother body has special liking towards Ind AS 102. They're going on creating some interesting questions of this standard. Okay. So yeah, so this is about, I'll give you a breakup of this, H and parent. You remember there was something called group share based plan, which we discussed and we have solved 4 or 5 questions on this. Group share based plan is a scenario where either holding company will give shares to subsidiary ka employee or subsidiary will give shares to holding ka employee. So one entity will get service, but another entity is giving shares. That we call it as group share based plan. Under that also there was 2 cases. There is obligation to reimburse or there is no obligation to reimburse. Usually they ask no obligation to reimburse. This is a no obligation to reimburse wala case, so I have written that. Like just to give you a recap, we'll discuss the entry first and then discuss the question. H Limited is the parent, S is a subsidiary. H, the parent is issuing the shares to subsidiary ka employee. If that is the case, means what entry you need to pass. I told you a simple thumb rule. Whichever entity is receiving service, they will book employee benefit expense. Now is H is issuing shares, but are they receiving service? No. Since the employees belong to subsidiary is receiving service. So H Limited can't pass the entry employee benefit expense account debit to SBPR. Shares are given, so SBPR. So employee benefit expense you cannot record. Parent is giving something to subsidiary, no, right? So this will be treated as, it will be like parent has made some investment in subsidiary. So the journal entry will pass as investment in subsidiary debit to SBPR. This is the journal entry parent will pass. What about subsidiary? They have received service. So they'll pass the entry employee benefit expense account debit. They can't credit SBPR because subsidiary is not giving shares. But who is giving shares? Parent. So subsidiary will treat this as a capital contribution from the parent. So the entry will be employee benefit expense to capital contribution from parent, basically other equity. This entry will pass. This is one case. Ulta case will be subsidiary giving shares to holding ka employee. That can also work. So if subsidiary is giving the shares to holding ka employee, what subsidiary will pass? Sir, if subsidiary is giving some benefit. If subsidiary is giving any benefit, means subsidiary will treat that as a dividend. Subsidiary can't debit employee benefit expense because it is holding ka employee, so holding company received service. So instead of writing employee benefit expense to SBPR, subsidiary will say dividend account debit to SBPR. That is one. Subsidiary will treat this as they have paid some dividend to holding. Okay. Now what about holding company? They have received service, so they will write employee benefit expense. They can't credit SBPR because they are not giving shares. But who is giving shares? Subsidiary, right? If subsidiary is giving some benefit, if subsidiary is treating it as a dividend paid, holding will treat it as a dividend received. So the entry will be employee benefit expense account debit to dividend account. This is a scenario. Okay. This is just a quick recap of the concept. Keep this in mind when we read this or go through this particular question. H is parent, S is subsidiary. H and S are unlisted entities. Some ESOP arrangement has taken place. Okay, this is the original scheme and some new scheme they have agreed upon. First, let's go through the original part of it. At the beginning of year 1, H, parent, granted 1,500 in its own shares to its own employee as well as S Limited ka employee. First of all, shares are being given out. So it is not cash settled plan, it is a equity settled plan. Okay. Now, parent is giving shares to their own employee plus also subsidiary ka employee. So both are there over here. Okay, that is one. How much? 1,000 shares were given by the parent to its own employee. 500 shares parent gave it to subsidiary ka employee. The fair value of the option is, one option is 15. But there is a condition that they have to work for 3 years. Vesting period is 3. H will settle its own equity shares. All options are expected to vest. H does not recharge to S Limited. H doesn't recharge to S Limited. Meaning H is giving some benefit to S ka employees. No. Is H taking it back? No, they're saying it doesn't recharge means H will give this benefit and they will never take back. Meaning this is what case? This is a case where there is no obligation to reimburse. Okay. Alright. Now what is the entry? This is first year. First year pretty basic now. Alright. We don't have to put up a expense because all the options are expected to vest. No, there is no change. So straightforward. So the loss you'll have to book is on one option 15. On 1500 you need to book the loss. So it's pretty straightforward calculation. So they've asked the journal entry here. They've asked 3 entries. One, in H Limited ka separate financial statement mein, what is the entry? That's a requirement. You need to pass the journal entries. Okay, all show the accounting treatment in CFSO as well as in SFS. In H Limited ka separate financial statement, what impact? S ka separate financial statement, what impact? Consolidated financial statement mein, what impact? All the 3 we need to call out. Consolidated we'll see later. First we'll finish for H and S. Okay, SFS may we'll finish. Now H is giving the shares. What is the journal entry? Employee, investment, no, hang on. Totally 1000 shares were given, 1500. In that 1500, 1000 shares is for their own employee and 500 is for subsidiary employee. Whatever shares parent is giving to subsidiary employee, that will be booked as investment. But the share that is given to their own employee, that will be employee benefit expenditure, right? Both are there over here. So the entry will be employee benefit expense account debit. How many shares? 1000 shares parent is giving to their own employee. And what is the loss on one share? 15 rupees. The fair value on the grant date they've told is here 15. On one share 15 rupees loss. On 1000 shares it will be 15,000 loss. The total loss you'll have to book it over vesting period. I think here vesting period was 3 years. So into we are in first year, hence 1/3. You will book employee benefit expense of 5,000. Pretty straightforward. Plus only 1000 shares are given. No, H is giving 500 more shares to subsidiary ka employee. For subsidiary ka employee, subsidiary will receive service. No, so we can't debit employee benefit expense. So what will we debit? Investment in subsidiary account debit. How many shares? 500. And the loss on one share is 15. This is a total loss, 7,500 or whatever, right? Sorry, that will be booked over vesting period of 3 years. So first year it will be 2,500. Since shares are given, we will book SBPR to SBPR 7,500. Okay. Now what about subsidiary? Subsidiary will not bother about this 1000 shares because this 1000 shares parent gave it to their own employee. So subsidiary has no role in this. 500 shares is given by the parent to subsidiary ka employee. So the relevant number of shares for subsidiary is only 500. Okay, so what entry will pass? Employee benefit expense because subsidiary received the service. How many? 500 into loss per option is 15. That you'll have to book it over vesting period of 3 years. So this much employee benefit expense subsidiary will pass. They can't credit SBPR because they are not issuing the shares. Who is issuing? Parent. So we'll treat this as capital contribution from the parent. This is a journal entry for first year in parent and subsidiary books. Okay. Alright. In consolidated financial statement, it's pretty straightforward. You just need to nullify this investment debit, this capital contribution credit, right? Both will get nullified. So effectively what? Employee benefit expense debit 5,000, 2,500. SBR credit 7,500. So if you add these two, you'll get employee. This two will get cut off. So effective entry will be employee benefit expense to SBPR 7,500, 7,500. That's all. Because totally 1,500 shares are given, no? And the loss per share is 15. You'll have to book it over vesting period. Like that also you can calculate. Or you can simply sum up the entries. Employee benefit expense, where and all you have debited, add. This debit, this credit will get nullified. SBPR credit 7,500 will remain. So that is a journal entry in consolidated financial statement for first year. Okay. Now, this drama is done. Let's get to the second year. What drama? Continuing, H and S are unlisted entities. However, at the end of year 1, S gets listed. Initially, H parent and subsidiary both were unlisted. End of first year, S Limited got listed. Now, what did they say? At the beginning of year 2, drama came in beginning of year 2. At the beginning of year 2, S Limited offers 1,500 options in its own shares to H Limited ka employee and its own employee. Sir, earlier the scheme was parent will give the shares to some its own employee and subsidiary ka employee, correct? That was the scheme. Parent will give totally 1,500 shares. Of this 1,500, 1,000 will be given to parent ka employees only, 500 to subsidiary ka employee. Second year beginning, reverse ulta. Subsidiary company got listed, no. See, we want listed company ka share so that it becomes easy to transact, to buy, so that employees also will feel good, no. Whenever they want, they can sell and they can go. So hence the scheme got reversed now. In year 2 beginning, what they're saying is, subsidiary is saying, I will give 1,500 shares. Of this 1,500, 1,000 shares I will give it to my parent ka employee and 500 to own employee. Same drama. Now subsidiary is saying 1000 shares I will give it to parent ka employee, 500 I will give it to my own employee. Since it got listed, they made this modification. Okay, it's a scheme. Who has issued the share, who's going to issue the shares? That's been reversed. Fair enough. But there's a condition. Condition upon H and employee surrendering the right over parent ka ESOP scheme. They put one condition saying earlier parent had to give the shares to employees, no? So now they are saying that right you surrender. Parent will not give any shares now. Subsidiary will give the same shares to the respective employee. Whatever right employees had to collect the shares from the parent, that they'll have to surrender, because parent will not issue the shares anymore. So the final takeaway is subsidiary will issue 1000 of its own shares to parent ka employee, and 500 shares subsidiary will issue to their own employee. That's a final scheme. And parent will not issue any shares. That's one. This happened in beginning of year 2. Okay, stop there. Now people, since it is again shares being issued, it is still an equity settled plan, so we don't have to worry about change. Now parent, now let's give this, all this drama happened at second year beginning. Now parent has already recorded SBPR, right? Because initially parent had to give the shares. Now is parent giving the shares? No. So is this SBPR required? Not required. So reverse it. Here you credited SBPR 7500, debited by 7500. That is one. Since you are not giving the shares, is this investment in subsidiary required? Not required. Credit that to investment in subsidiary company. Okay. All right. Now, initially, parent was thinking that we will give shares worth 5,000 to our own employee, or we will give the shares to our own employee, and the expense books was 5,000. Now, are we incurring the shares or subsidiary is giving the shares? Subsidiary is giving the share. Sir, if subsidiary is giving something to parent, and if there is no obligation to dividend, remember we discussed this. If subsidiary is giving something to parent and if there is no obligation, parent will show this as what? Dividend. So that means here, parent has to show this as dividend. SBPR, once again I'll tell you, SBPR is not required anymore because parent is not issuing the shares. Reverse it. Here you had credited, second year beginning, you debited. Investment is not required. Here you debited, so credited. Don't credit employee benefit expense over here because benefit is still given, but just that the parent is not giving this benefit, but who is giving? Subsidiary is giving this benefit to parent ka employee. If subsidiary is giving some benefit to the parent, parent will show that as a dividend to dividend. How many? 1000 shares. Subsidiary is giving 1000 shares to parent ka employee, as they said, no? Okay, that amount. Okay, and the loss on one share is 15 rupees. You'll have to book this over 3 years because vesting period is 3 years. Hence that amount, or you can get it as a balancing figure. That is one. Okay, now you'll have to do the reversal. Here, now this is over for parent. What will subsidiary do? They had shown capital contribution from parent, but as parent is not giving anything now, right? They did the ulta scheme. So this capital contribution is not required anymore. Reverse it. Capital contribution debit 2500. But subsidiary is giving the shares to parent ka employees. If subsidiary is giving shares to parent ka employees, means subsidiary will treat it as what? Dividend. So parent credited this as a dividend received. Subsidiary will show this as a dividend. Dividend payable, right? So dividend account debit. How much? Shares to the extent of shares given to parent ka employee. How many shares is that? 1000 shares subsidiary is giving to parent ka employee, and the loss on one share is 15. You'll have to book it over 3 years. So dividend 5,000. Since parent is giving the shares, no, they will credit SBPR to the extent of 7,500. That's all. Parent will reverse that and subsidiary will recognize that. That's all it is. So yeah, whatever is not required, reverse it, but do not forget to recognize a dividend there. That's okay. If you are not able to complete full entry, at least do that. Like here, very simple thing is okay. Capital contribution not required, debit it. Since subsidiary is giving some parents, subsidiary is giving some benefit to parent, subsidiary will have to account it as dividend. On what shares? The shares given to parent ka employee. So these two you can book. Correct? No. So entry will be what? When subsidiary gives any ESOP plan to parent, the entry will be dividend to SBPR. So you can get this as a balancing figure. Okay. Now in consolidated financial statement, what will happen? SBPR debit, SBPR credit, nullified. Investment credit 2500, capital contribution debit 2500, nullified. Okay. Yes, no. So dividend debit 5,000, dividend credit 5,000. That means what? Effectively, you'll have to do nothing. You'll have to do over here. Everything is getting squashed out there. Okay, no. That's pretty much it. Okay. So no, sir, this has to be reversed. Hey, this one should not be reversed. It is just that expense is still there. Instead of holding company giving this benefit, subsidiary is giving this benefit. So expense is still there. So don't say this entry ka ulta should come. No, because instead of parent giving the benefit, subsidiary is giving the benefit now. So expense still has to be recorded. So reversal will not happen. Hence, when you add these two entries, that's the reason I said in CFSMA it's much easier to compare, add these two and get the entry finally. Okay. So again, SBPR debit credit, capital contribution debit, investment credit same amount, dividend debit same amount, dividend credit same amount. Everything will get nullified. So in CFSMA the final effect is 0. Okay. This is when the scheme change happened, we'll do this, which is year 2 ka beginning. Now they've given further data. Check what is that to. Okay, this is done. Remaining vesting period is same as H Limited ka ESOP scheme, that they did not change. Originally vesting period was 3 years. No, 1 year is already passed. So remaining is 2 years. That is still the same. No change in that. Incremental fair value of new ESOP scheme is 6 rupees. Now we have done a modification, sir. If you remember, you have done a modification, right? Whenever there is a modification, incremental fair value means it's an additional loss company is bearing. Whenever there is modification, we used to say, if there is an unfavorable modification done by the company from employee viewpoint, you always need to check whenever the modification has come, think of it from the employee perspective. If it is unfavorable means ignore. If it is favorable modification which you have done, then whatever additional expenditure you are getting, that has to be booked over the remaining vesting period. If you remember, whenever modification is favorable to the employee, that additional expense the company has to book over the remaining vesting period, which is 2 years. Now, due to this modification, obviously parent ka and subsidiary ka share worth will not be same. No, it will be changed. So now they are saying additional loss company has to suffer is 6 rupees. There is additional expenditure for 1 share that you'll have to book it over remaining vesting period. All options are expected to vest. Okay. Now all the employees have gone for this new scheme. All of them are fine. So you need to, and S also doesn't recharge for ESOP. So it has no obligation to reimburse wala scenario. Now the entry at second year ending, what you have to pass. Okay, additional expenditure has come. So whenever modification has come, whatever original expenditure you were booking, that will continue. Additional expenditure you need to book over the remaining vesting period. That's all. Now let's do it from H Limited perspective first. Is H giving any shares? No. So can they book SBPR? No, because they're not issuing shares. But H Limited ka employees, okay, H Limited ka employees, they are receiving shares from whom? Subsidiary. Right? I mean, subsidiary is giving some benefit to the parent again, right? So second year, what entry will pass, right? Instead of employee, since it is so parent ka employee, parent will pass the entry employee benefit expenditure account debit. They can't credit SBPR because parent is not giving shares. Who's giving shares? Subsidiary. So you will credit dividend. This is a journal entry. Employee benefit expense account debit to dividend, right? The original expenditure of employee benefit expenditure will continue. Original is how much? 1000 shares. And the loss on how many, loss per share is how much? 15. You'll have to book it equally over. Since there is no change, this 15,000 you'll book it equally over 3 years. 5,000. So this is the expenditure on the original scheme. Now you modified. So you'll get additional cost. What is that additional cost? Due to this modification, you'll have to incur an extra expenditure of 6 rupees per share. So the loss per share is not 15 now, it is 6 rupees. Okay. How many employees? 1000 employees of parent, and extra loss is 6 rupees per share. Now this you don't do 1 by 3. Why? This is the additional expenditure due to modification. In Ind AS 102 says whenever you do modification, additional expenditure should be booked over the remaining vesting period. Now 1 year is already over. All this came in year 2. So remaining vesting period is year 2 and year 3, 2 years. So this much expenditure, you will book it over 2 years. So this is 5,000, this is 3,000. So total employee benefit expenditure is 8,000. Why 1,000? Because 1,000 shares is given to parent ka employees. Hence we have only considered 1,000. Okay, totally subsidiary get 1,500 shares. In that 1,500, 1,000 belongs to parent employees, 500 belongs to subsidiary ka employees. So since 500 shares subsidiary is giving to their own employee, that entry will not come here. Parent will only recognize the expenditure relating to their employee, which is this. But not only the original, but also additional cost. Okay, same calculation, but book it over the remaining vesting period of 2 years. And there's an additional cost. Done. What is the entry subsidiary will pass? Now subsidiary is issuing totally how many shares? 1,500, right? Not 1,000, 1,500. 1,000 is given to parent ka employee. 500 is given to subsidiary ka employee. So we'll have to book the expenditure on how many shares? 1500 shares. If you want, you can book it separately only, better. Okay. Now what is the entry? So first, 500 shares subsidiary is giving to their own employee and subsidiary only receive the service. So employee benefit expenditure debit. How many shares? 500. Okay. All right. What is the loss per share? 15. You'll have to book it over the vesting period 1/3. This is the original expenditure. Okay. Now you modified, due to modification, you got extra expenditure, right? How much is that? Extra is 6 per share. How many shares? 500. Extra expenditure per share is 6 rupees. This you'll have to book it over the remaining vesting period, which is 2 years, because this is additional cost. Okay. This is the expenditure on original. This is the due to modification. Okay. Due to modification, if you're getting any additional cost, it has to be booked over remaining vesting period. This is one. If you add this, you'll get 4,000. That is one. But is subsidiary giving only 500 shares or 1000 also? Subsidiary is giving 1000 shares to parent ka employee. So who's receiving the service? Parent. But who's giving the shares? Subsidiary. So if subsidiary is giving some benefits to parent, they will recognize it as a dividend. So dividend account debit. How many shares? 1000 shares. What is the loss per share? 15 originally. You'll recognize over the vesting period of 3 years. Only this? No, there's a modification. Due to modification, you got additional cost. How much? 6 per share. How many shares? 1000. Over the remaining vesting period of 2 years. So this is your dividend portion. Since subsidiary is giving the shares, you will credit SBPR. Adding these two, you will directly get SBPR. Okay, you can calculate also, or simply take it as this. SBPR is totally 1500 shares. Now, do the same calculation for 1500 shares basically, or get it as balancing figure. 8 plus 4, 12. That's it. Okay, Ji. Now, in consolidated financial statement, what you do? Employee benefit expenditure. Employee benefit expenditure debit 8, here debit 4. So totally it is 12,000. Okay. Dividend credit 8,000, dividend debit 8,000. It will get nullified. Okay. Then means remaining is SBPR. SBPR how much? 12,000. To SBPR 12,000. That's all. The entry matched out. Okay. All right. Fine. But one more thing is this SBPR. SBPR is a reserve, right? This SBPR, no, don't give it to the parent. Okay. You give it off to your NCA. Okay, because the shares are given there. Okay, they have not asked that, leave that, it's fine. Okay, all right. So that is the entry with respect to this particular ESOP. Easy only, but you just need to be little careful on this bifurcation and the calculation of amount. Once I suggest review this, preferably after reviewing, once put it up, solve it off. Just the entry quickly try to solve so that you have that more clarity over this. Okay, this is an LDR. Question number 12 is on Ind AS 21, that is also LDR. Parent A is a reporting entity that has net investment in foreign operation. It has 2 foreign subsidiaries, B and C. Okay. 2 subsidiary there. Okay. In all the following scenarios, loan made between group entities is permanent in nature. That is, settlement is neither planned nor likely to occur. Sir, if you remember, we have discussed this, right? Sir, let's say parent is given some loan to subsidiary company. Parent does not want to recover. Now, since the transaction would have happened, parent ka report functional currency can be different, subsidiary ka functional currency can be different, right? Loan given as a monetary item. Monetary item should be restated using closing rate, and monetary item should be restated using closing rate, and that comes in your balance sheet, right? When you restate using, initially you would have converted monetary item using transaction date ka spot rate, but on the reporting date you will restate using closing rate. So due to this restatement of monetary item at closing rate, you will get some forex gain or loss. So forex gain or loss on monetary item in separate financial statement will go off to SPL. What will happen in consolidated financial statement? So in consolidated it will get cancelled, no sir? Yeah. Loan given is an asset for one entity. Let's say parent is given loan to subsidiary. So for parent it's a financial asset, loan given. For subsidiary, it's a financial liability, loan taken. So it's a mutual owing. It will get cancelled. It should ideally get cancelled. But no. Parent is showing loan, let's say in Indian rupees. Subsidiary is showing that loan in dollars. Possible because it could be a foreign subsidiary, right? So that financial asset, financial liability will get nullified. But exchange, one entity like parent, if they are showing loan in Indian rupees, then functional currency, if it is Indian rupees, nothing will come. No gain or loss will come. Okay. But subsidiary has to show the loan not in Indian rupees, since their functional currency is dollars. From Indian rupees, they'll convert it into dollars. Initially using transaction date ka spot rate, on the reporting date they will use closing rate. So on this financial liability for subsidiary, there will be some exchange gain or loss. So that will remain. So that will come in consolidated financial statement also, right? Where it will come. If you have intention to recover, then in SFS mein and CFS mein, both the gain will be shown in SPL. If you don't have intention to recover, then in SFS mein, since the gain is relating to monetary item, it will always go to SPL. In consolidated financial statement mein, it will be shown in OCI. If there is no intention to recover, that's all this is concept. We have done a question also on this. So it is in a way a repeat question, but since they've given two subsidiary wala data, we'll quickly run it by. So parent has two foreign subsidiaries. Parent is, where is that? Parent is A, two subsidiaries are B and C. First case, parent A with sterling as functional currency. Maybe A Limited is in our UK. So they have sterling pounds as their functional currency. Financial statement ends on 31st March. It has a loan receivable of $1 million from subsidiary C. So A has given a loan to, parent has given a loan to subsidiary C. A ka functional currency is pounds, sterling pounds. But C ka, it is dollars because we have given the loan in dollars. Okay. Alright. It has been outstanding for some time. The parent notified subsidiary at the beginning of the year that no payment of the amount will be requested. So there is no intention to recover. So all you have to say is what, sir? That's what they're saying. What will you do for this exchange difference in SFS and CFS? Okay. First, let's find the forex gain or loss. A Limited. A Limited is a parent. No? They've given a loan to subsidiary C. Okay, but this loan is not given in functional currency of sterling pounds. It is given in a foreign currency called $1 million. Any currency other than functional currency is a foreign currency, right? So you need to convert. Okay. Now they have said, all right, last year they've given 2 years data. Currently we are on 31st March 20x5 people. Okay. On 31st March 20x4, this loan was converted at £1 is equal to $1.45. This was the closing rate of last year. Okay. Every reporting period, monetary item should be restated using closing rate. So last year when you prepared a balance sheet, you have converted this loan using this rate. Okay. £1 is equal to $1.45. Okay. It's, if you're confused about multiplication or division, put up this X. Sir, £1, or maybe I'll put up like, yeah, £1 is equal to $1.45. $1.45. And we have $1 million. So $1 million or 1 million is 10 lakh, no? So 10 lakh dollars means how many pounds? So now you'll get to know that you have to divide this, cross multiply. So 10 lakh divided by 1.45. So last year you would have shown this loan at, this is 10 lakh dollars. 10 lakh dollars divided by 1.82 if you do. Alright, okay. Sorry, last year, this 1.45 last year. The balance was 6,89,655 pounds. So A Limited was showing the loan in their last year balance sheet at this much value. Last year ka closing balance will become current year ka opening balance. Okay. Now current year also has ended. Loan is still going on and loan is a monetary item. Again, monetary item should be restated using closing rate. Current year ka closing rate is 31st March 20x5 1.82. Again reconvert. Same that $1 million or 10 lakh dollars reconvert using 1.82 now. Okay, that's a closing rate now. It will get 5,49,450. Mind you, people, there's not liability, there's an asset. Parent is given a loan to subsidiary in foreign currency, right? Last year, we thought we will recover how much? This asset ka balance in the last year was 689, but current year it has become 549. From 689, it has become 549. Asset balance is reducing. That means it's a gain or a loss? Loss. So this is your forex loss. How much? 1,40,205 pounds. Since this loan given as a monetary item, in separate financial statement, mein, monetary item ka gain loss always goes to SPL. But in consolidated financial statement, mein, for parent it's a loan given, for subsidiary it's a loan taken. That will get nullified. But this exchange difference will be there. So where should you show this exchange difference in CFS? Since there is no intention to recover, it will go off to OCI. If there was intention to recover, then in consolidation financial statement also it will go to SPL. So based on that. Okay. Now same calculation, you'll have to do it for one more entity, same fact. So now parent has loan receivable from C for 2 lakh pounds. Parent ka functional currency is pounds. Transaction is done in pounds only. Okay. Alright, it has been outstanding. Now what people? But they've changed the amount. Instead of $1 million, now they made it as 2 million pounds. So parent, there is no headache because parent ka functional currency is pounds and the transaction was done in pounds, so nothing will happen. I mean, the drama will come for a subsidiary company. Parent has given loan, no? I mean, subsidiary has taken a loan. It's a liability. Loan taken is also monetary item. Last year, they would have converted this 2 lakh pounds. They can't record it in pounds. Their functional currency is dollars. From pounds, they have to convert it into dollars. Last year, what they would have done, 1 pound is equal to $1.45. 1 pound, one pound is equal to, last year, how much is what? $1.45. Okay. So therefore, how much? 2 million pounds is how much? Or 2 lakh pounds is how much? 2 lakh pounds will be how much? So that means this is not a case of division, it's a case of multiplication. So last year they would have done 2 lakh into 1.45. So they were showing in their books, when they subsidiary prepared balance sheet of the last year, they were showing this loan as a financial liability at $290,000. Okay. Now current year also has ended. Every year you have to restate at closing rate. Current year ka closing rate is 1.82. So 2 lakh you multiply by 1.82. How much it became? 3,64,000. So forex gain, no, macha, this is loan taken da. Okay, for parent it is loan given, for subsidiary it is loan taken. So now subsidiary has to do the conversion, right? Because they have to convert from pound to dollars for accounting purpose. Last year that liability ka balance was 290. Current year it has become 364. So liability balance has increased by $74,000. A liability increasing is a forex loss, no? Same thing. So in separate financial statement, the subsidiary C will show this loss in SPL. In consolidated financial statement, they will show it in OCI. Why? There is no intention to recover. That's the reason. Okay, that's all it is. Okay, same chin to pinto calculations. Okay, next question number 13. Goes without saying, everything is LDR. During 20x3, this is an Ind AS 8 wala question. During 20x3, keep that in mind, period is important here. T discovered that prepayments of 680 made during 20x1 had not recognized in P&L as related expenditures were incurred. Some expenditure they forgot to record. Okay, all right. When the prepayment should have been recognized as an expense of 170 in 20x1, 425 in x2, 85 in x3. So maybe if you add all this, you will get 680. Okay, so basically, all right, this much expenditure you have to recognize in year 1, this is year 2, and currently we are in year 3 this year. Okay, so we forgot to record the expenditure the last year and last to last year worth this much. That we got to know that in the current year. So in the last 2 years we have made a mistake. So there's an error, and they're saying this misstatement is material. It's not a small amount, it is a material one. Okay, P&L extract they have given, SOC extract they have given. Now they are saying you need to revise the P&L and SOC you need to prepare. That's all. Okay, correcting the error you need to prepare it. So very straightforward question, sir. All right. So error what, sir? Current year is 20x3. So last year will be x2. Right? Current year ka and last year ka comparative financials. I mean current year data we will give along with the last year ka comparatives we give. So current year ka error easily you can correct. Last year ka error also you can easily correct. If the error goes beyond the previous year, you need to prepare third balance sheet by adjusting components. If the error is done in relating to P&L items, right, we adjust it through retained earnings, if you remember. Okay, if error goes beyond the previous year, we have to prepare third balance sheet. If the asset relates to asset liabilities, then we will not use retained earnings, we will adjust it in asset liability only, right? But if the error relates to an expenditure or an income, right, that we'll adjust it through retained earnings. There's an expense related error. First, let's do it for current year and last year. Last year first. How much they have given? Revenue is 6,800. Expense they have taken 6,120. Sir, one expenditure they did not take. So we can't take 6,120. How much was the expenditure for last year? It was missed out 425. So instead of taking 6,120, take 6,120 plus 425. So the correct expenditure is 6,545. Okay. So this is the revenue, this is the expense. So if you do it, you will get the correct profit of 255. We'll do this in comparative financial statement. Hence we use the term x2 in bracket may we say restated. So there's an error, so we are restating. This is for when you prepare current year financial statement, last year figures you will show this. Hence restatement. What about current year? Current year still it is open, no, we can correct it. Revenue same, 10,200, no change. Expenditure they have shown is 9,350. But one expenditure for current year not recognized, how much? 85 they've given. X3 is current year. 85 not recognized. So expenditure is not 9350. 85 also is an expenditure which is not yet recognized. Add this is the expenditure. So this is your revenue, this is your expenditure. So these two come minus. If you do, you will automatically get profit for the current year. Okay, this is sorted. Now error also relates to 20x1 now. It's going beyond the previous year. That we don't give comparative financial statement. Since it's an expense related error, we have to adjust through retained earnings. Like here, check, they've given SOC for it. X2, right? When you did X2, opening balance of retained earnings is given. Sir, X20X1 ka closing balance only becomes 20X2 ka opening balance, right? 20X1 ka closing will become 20X2 ka opening. So basically for X1, okay, our opening balance of retained earnings is how much? We'll start with that. The opening balance, so X2, no, maybe you'll call it as, I don't know, I think here, no, it's maybe instead of 1st April, let's call it as 1st January. I think here it is Jan to December wala year. Okay, no problem. I'll just call it as this. Okay, period. I'll just probably change the dates over here. Okay. Okay, this is X2, this is X3. Okay, maybe I'll look at that. Okay, so on 1st January, actually, 1st January 20X2 only, this is my bad. 1st January 20X2, retained earnings opening balance was how much? 23,800, correct? No, but current year ka error, last year ka error we already rectified. But error goes beyond previous year. Last to last year also there was an error. What was that? Last to last year is 20X1. That year mein 170 expenditure you did not recognize. Okay, so if you don't recognize one expenditure, if you don't account one expenditure, means P&L balance will get unnecessarily increased. P&L only you will show it in your balance sheet as retained earnings now. So the retained earnings balance should not be 23,800. One expense of 170 in 20X1 was not recorded. So now correct that. So correct profit is not 23,800. 23,800 minus 170 you will get the correct opening balance of profit. Start with that. That is 1st January 20X2. Okay, so this is the balance. This is how the correct. So current year ka last year error we corrected here only. Any error which is going beyond previous year, any error relating to income and expenditure which is going beyond previous year, we'll adjust it through retained earnings by adding or minusing. Here we have to minus because an expenditure was not recorded. So retained earnings balance is unnecessarily increased. So we are reducing it. Okay, that's it. So this is the restated retained earnings balance. Now you add what? 20X2 ka profit. How much was the correct profit of 20X2? 255. Add it. You will get second year ka 20X2 ka. Okay, 20X2 ka. All right. The retained earnings ka closing balance. Then add the correct profit of 20X3. Correct profit of 20X3 765. So add that. You will get the closing balance of retained earnings as in 31st December 20X3. That's it. So here we have already corrected. Error going beyond previous year, we adjusted through opening balance of retained earnings. That's it. So take the number given, correct the error, and you'll get the restated opening balance. You can also present in this fashion only. Okay, it's fine. All right, in same format. Here I've just done for both the years together. You can open, you can do the presentation this way. Easy only. I think this sort of questions also we have done. Nothing much new here actually, but okay, still. Yeah, so sorted. That's all, people. Okay, next question number 14. Oh, so it's a Ind AS 115 question. I'll keep this as an LDR. A has entered into a contract with a customer for supplying of a paint for 3-year period. Okay. A makes 50,000 upfront payment, which the customer will use to customize its paint sprayers for A ka product. All right. Excuse me. Right. So we have entered into a contract that we will supply paint. Right, but A is making some upfront payment with payment which customer will use to customize its paint sprayers for A's product. Fine, it's a payment made to the customer. Okay, all right. A determines that upfront payment is not in respect of distinct goods or service. Sir, whenever you have collected some upfront fees and all, you have to check whether it is for distinct goods or service. right? Here it's not for distinct goods or service, right? In fact, what, sir? All right, it's a payment made to the customer, right? So if it's not for distinct goods or service, if it is for distinct goods or service, then we will treat this as a purchase, and our revenue we will book it separately, because on one hand you're collecting money from customer, okay, so that will be your revenue. On one hand you're paying money to the customer. So whatever money you are paying to the customer, for that if you are getting any distinct goods or service, you will treat that as normal purchase, because you have received some goods and you have made the payment. You will account it as separate purchases. Fine, like that. But here they are saying it is not for distinct goods or service. So you have made some payment to the customer, all right. But if you have not received, any distinct goods or service, means what you'll have to do? This amount upfront fees, no, 50,000, you'll have to reduce from revenue. You have to reduce from revenue. If you remember the Maggie example I used to give in class, right? The shelf and all. I think we have done such questions in the class also. All right. I think similar one is there. But anyway, still we will do it. Okay. So this 50,000 we have to reduce from revenue, because you are not receiving any distinct goods or service for this. Okay. Contract is for 3 years. Keep that in mind. A is estimating that 10 lakh we will achieve over 3-year period. Totally, we will make a sale of 10 lakh. Okay. For first quarter, the sale is 1 lakh. Second quarter, 125. However, A updated its estimated total sales over the contract to 15 lakh in quarter 2. First quarter when we were there, we thought we will sell goods worth 10 lakh to the customer. Second quarter, it's progressed better. So we feel totally 15 lakh we'll sell it to the customer. How much revenue in Q1 and Q2 you need to book is what they're trying to say. All right. Sir, you have already delivered the goods. So performance obligation is complete, right? All the steps are done, right? So can you recognize 1 lakh revenue? Yes, but hang on. You also have made a payment to the customer and you did not get any distinct goods or service. So this 50,000 you'll have to reduce from revenue. So first quarter you can't book 1 lakh as revenue. There will be some reduction. And entire 50,000 you cannot book. Entire 50,000 you cannot reduce in one shot, because this 50,000 upfront fees is what you're paid is for the contract, and contract will last for 3 years, right? And you are only in first quarter. So entire 50 you cannot reduce. You have to reduce it in phases. As each quarter passes, you will have to go on reducing a portion of this 50,000 gradually. So how much to reduce is the first question. Okay, now let's do it. So 50,000 has to be reduced from revenue over the contract duration. That's first. Okay. How much to revenue? How much to reduce? First, in the first quarter, how much sales have you made? Actual sales we have made is 1 lakh. And we thought how much are we going to achieve in total? We feel in first quarter, we feel totally we will sell goods worth 10 lakh to the customer. 1 lakh we have already sold, and we feel in totality we may sell goods worth 10 lakh over 3 years duration. So out of 10 lakh, if 1 lakh if you have sold means what is it in percentage? Totally 10 lakh we are expecting to sell to the customer. In that 1 lakh we have already sold means 10% sales estimated we have already completed, because 10 lakh or 10% if you do, you'll get 1 lakh now. Correct? So 10% of your target you have achieved in first quarter. That means what? Out of this 50,000 payment, 10% you'll reduce from revenue. Why 10%? Because that's the target you have achieved. So the revenue to be recognized in the first quarter is the sales made of 1 lakh minus that payment ka adjustment. You have made 50,000 payment to the customer. We have not received this. We have paid this. It is not for distinct goods or service. So you have to reduce from revenue. How much to reduce from revenue? 10%. Why 10%? That's the percentage of sales completed in first quarter. So 50,000 ka 10% is 5,000. So out of this 50,000 payment, 5,000 you'll reduce in first quarter. Remaining you'll reduce over the remaining quarters, like that. So the revenue recognized in first year is 95, like that. Okay. Now second quarter, estimate changed. Second quarter we achieved how much in second quarter? 1,25,000. And total estimated sales is 15 lakh, right? So we achieved 1,25,000 sales. So now we are saying we will not sell goods worth 10 lakh. We will sell 15 lakh. That means how much target you have completed. So first quarter you have already sold 1 lakh. Second quarter you have sold 125. So totally you have made a sale of 2,25,000. Till second quarter, 2,25,000 product is already sold. How much you feel in totality you will sell? 15 lakh. In 15 lakh, 225 product, 2,25,000 worth of product you have sold. So what is the percentage? 15%. So till, this is not percentage for second quarter. This is a percentage of target completed till second quarter. Q1 plus Q2 put together. Okay. So as of Q2, when you are in Q2, totally 15% of the target you have achieved. Sorry, 15% sales you have made means 50,000 of this prepayment also you can adjust. So 50,000 ka 15% is how much? 7,500 you'll have to adjust basically. Okay. Till the end of second quarter, 7,500 ka payment portion you need to adjust till second quarter. Totally 7,500 has to be adjusted till second quarter. But in the 7,500, 5,000 you already adjusted in first quarter only. This is a total, mind you. This 15% is not percentage for second quarter. It is a percentage for Q1 and Q2 put together. Okay. So totally you need to adjust. Okay, 7,500, 50,000 ka 15%. By the end of second quarter, this much you should have already adjusted. That much you should have reduced from revenue. But in Q1, you already adjusted 5,000, right? So how much more you need to adjust in second quarter? In 7,500, 5,000 is already adjusted in Q1, means 2,500 of payment made to the customer will be adjusted in quarter number 2. This much you'll have to deduct basically. Okay. How much products did you sell actually in Q2? 1,25,000. And how much payment made to customer you need to adjust? 2,500. So this is the revenue that you will book in the second quarter. That's it. Okay. A good question in a way. Done. Okay, people. This is sorted. Next. Question number 15. This is on the financial instrument wala question. I'll keep this also as an LDR. A Limited has issued optionally convertible debentures amounting to 300 crores to B. We have issued the debentures to B. Okay. Terms. Term is 4 years. Duration is 4 years. Coupon as an interest rate. Debentures now. Right. So the actual interest rate is 0. That's what is coupon. IRR is 15% is what they've given. Okay. Why have they given that? We'll see. During the tenure of this optionally convertible debentures, A can call OCD and redeem it with a stated IRR. So the term is 4 years. Maybe A Limited, no, they don't have to wait till 4 years to redeem this debentures. They can redeem before also. The market rate for similar debt without conversion feature is 17%. Now you have given some conversion biscuit here, no? Because you have given conversion biscuit, the actual coupon rate is the debenture holders are okay in not accepting any interest. The company is able to convince the investors for 0% interest rate. If you had not given this conversion option, market interest rate would have been 17%. Okay. Yeah, this only we call it as compound financial instrument. No, this will have both. Such questions we have done. It will have financial liability feature as well as equity feature. Okay. B Limited can also ask for conversion anytime before maturity based on following formula. So anybody can get this converted. Option issuer also has, A also has his option to redeem before. B also has an option to redeem, but based on fixed formula. What is that formula? Investment amount. Investor has invested 300 crore plus applicable IRR, which is 15% per annum. Okay. Divided by the face value of the share, that is 10. Okay. Like that, they can ask for conversion. This is the amount payable. And if you do divided by 10, you'll get the number of shares. Okay, that's the conversion option. If redemption or conversion does not happen before maturity, then OCDs will be redeemed mandatorily in the same manner as for conversion. So if nobody initiates and if conversion does not happen, A does not convert till 4 years, B also does not ask till 4 years, then once the maturity period is over, using the same formula, compulsorily these debentures will get redeemed. So basically 4 years is a maximum term. How this instrument should be accounted, they are put it in 2 cases. Okay. All right. Fair enough. Both the cases any which way is same. Okay. Now people first case. Now A Limited has issued this instrument now. Right. Excuse me. So it's a case of financial liability. You can't say it's a pure financial liability because if conversion feature was not there, interest rate would have been 17. So this is a compound financial instrument. In compound financial instrument, we'll have to split between financial liability and equity. And how do you measure financial liability? Financial liability, you measure it at present value of future cash flows discounted at market rate. So what will be the future cash flows? People, doesn't matter. Even if nobody converts it, even if nobody initiates conversion within 4 years, once the maturity is over, mandatorily you will have to pay. Yes or no? Mandatorily you will have to do it. You can't escape from it. Okay, using the same formula. Matlab, how much A Limited will have to pay? 300 crores they have collected. IRR, they're saying take the investment amount and add IRR. Now 4 years over, if nobody is converting, means how much amount A has to pay B? 300 crore plus IRR. IRR is 15% per annum. 4 years is over. That means you will have to add 300 you take and add 15%, or oh, 1 minute. Okay, IRR is not 17, IRR is 15%. Yeah, add 15% 4 times. So you will get 524.7018 crores. So you'll have to make a payment of this much. Now at the end of 4th year, you'll make it every year or once. So financial liability, since you'll measure it at present value of future cash flows discounted at market rate. Market rate is not 15, market rate is 17. So use 17% discount factor for 4th year and get the present value of this. Okay, this is the payment expected to be made at the end of 4th year. Once again, I'll tell you how. So you'll have to make a payment through one formula. What formula? Take the investment amount and to that you add IRR. Now we are thinking, like, if the instrument goes on, nobody initiates conversion, instrument will go on for 4 years now. And IRR is 15% per annum. So you take 300 and add 15% 4 times. Why 4 times? The term is 4 years. So this much amount will be expected to be paid. Okay, but this will be expected to be paid in future. Okay, so we need present value. For that, for fair value calculation, we always use market rate. Market rate is 17%. So find PVIF because the payment is only happening once now. So present value interest factor at 17% for 4th year, which is this. So this is the value of the financial liability that you will recognize initially. But how much money was collected? 300 crore. Transaction price is 300 crore. In that, if 280 is financial liability, means balance will be equity. That's all. Okay. So equity portion will be balance of this, which is 20 crore. So the entry you will pass is what? Bank account debit 300 crore to financial liability 280 to equity portion of compound financial instrument 280, like this. Okay. Then for this financial liability, you do ACM accounting, right? So normal 4 years may you put up. Okay. All right. Opening balance. So finance charges. So finance charges here, no, don't take 15%. Usually we book finance charges at effective interest rate. Don't take 15%. Because if you take 15%, no. See, IRR means what? Or effective interest rate means what? A rate at which present value of cash inflow will be equal to present value of cash outflow. A rate at which present value of cash inflow will be equal to present value of cash outflow. Currently, present value is 280. Okay. In future, the value is 524. At what rate these two will be equal? That only we call it as effective interest rate. Now, we made this calculation at 17%. Now. We made this calculation at 17%. At 17%, okay, these two value will become 0. Or matlab same. If you take 280 crore and add 17% 4 times, okay, you will end up getting 524.7018. Okay, so at 17%, these two like here, you can treat this as an inflow, you can treat this as an outflow, right? So this outflow and inflow will be equal at what rate? 17%. So hence, don't be misled by the term IRR and book finance charges at 15%. Book it at 17 only. Okay, IRR means a rate at which inflow, present value of cash inflow and present value of cash outflow should be same. These two should become same. These two will become same only at 17%. If you want to check, take 17%. Put up ACM table for 4 years. 4th year, what is the closing balance you are getting? 524.7. That is what you are showing here. Only at 17%, okay, this present value of cash inflow will be equal to present value of cash outflow. Okay, so book finance charges at 17% only. Payment is 0 because the actual coupon rate is 0. You're not paying any interest. Okay, so this is the closing balance. Okay, G. Done. Okay, now what is the case? So B limited opts for conversion. Okay, before maturity. Okay, now they're saying 2 cases they're asked to. When B limited opts for conversion before maturity at the end of 1st year. At the end of 1st year only, if it is converted, what will happen is what they're asking. 2 cases, we'll see. Okay, if it gets converted, then what you have to do? Initially, you have already passed this entry, bank account debit to financial liability to equity. If it gets converted, in fact, first let's find out the balance also. Right, 1st year drama is happening. No, so 1st year you'll also book finance charges. Finance charges account debit to financial liability. So these two entry are passed and the financial liability balance at the end of 1st year has become 327.6. Correct. Now the investor is saying, give my money back. Give my money back. So you'll have to pay using this formula only. What is that formula? Investment amount plus IRR. That's what we have done here. There's the initial investment amount plus IRR. We are treating this as the initial investment amount. So the balance will be 327.6 crore. Since you are converting this, financial liability is no more required. So you'll write financial liability account debit 327.6 crore to equity share capital because you're giving shares. No? What ICI has done is they have done financial liability to equity share capital for same amount. But you also have Here, no, it's a compound financial instrument. You also had equity portion of compound financial instrument, which you are recognized for 20, right? This also I feel should be released to equity share capital. That's how we do it, right? When a compound financial instrument gets converted, you don't need financial liability also. You don't need equity portion of compound financial instrument also. Both will go off to equity share capital. I feel this should have been the entry, but ICI has not recorded this. The entry they have passed is financial liability account debit 327.6 crore to equity share capital 327.6 crore. This totally they have missed out. In my view, it should be considered, but anyway, rest I'll leave it to your judgment what you want to do. That is one first case, man. Now they are saying when B Limited does not opt for conversion and OCDs are redeemed at maturity. Both the cases. Sir, first is a case where first year it got converted. That is one. Now, for that entry we have already passed. Now they are saying B Limited does not opt for conversion and this debentures, optionally convertible debentures, are redeemed at maturity. At maturity, you did not convert, you repay. Okay. Now what do you have to do? That will go on till 4 years now, because the term is 4 years. At end of 4th year, debenture ka value will be, or financial liability value is 524.7. So take financial liability 524.7 to bank account 524.7. This is the entry ICS passed. I feel one more entry should have been passed. This equity is not required anymore. You'll have to release it into retained earnings, in my view. That portion in this problem, totally they've ignored this equity one. They only accounted financial liability wala portion. That's all this is. A very simple wala question. Okay. Just that, know that it's a compound financial instrument. You'll have to measure, just as a quick recap I'm saying, right? This is a compound financial instrument. Initially, you'll have to measure financial liability at present value of future cash flows discounted at market rate of 17%. But that future cash flow, how much you will pay, is dependent on IRR. Okay. Since the term is 4 years, you'll have to take the investment amount and add IRR 4 times because the term is 4 years. So that way you'll get the amount to be settled after 4 years. This is the future value. Get the present value by using market rate. You'll get the financial liability value initially. Difference between transaction price and financial liability value will become equity. And for this financial liability, put up ACM table. But don't use 15% as effective interest rate, because effective interest rate means a rate at which present value of cash inflow and outflow becomes same. In this problem, they become same only at 17%. So book it at 17%. That's when from 280, it will become 524.7. See, these two. But only at 17% it will match. So book finance charges at 17. Now they told first year only conversion happened. If first year conversion happened means whatever balance you have as financial liability in first year, from financial liability, you will transfer it to equity share capital. That's it. Second option, where they told conversion did not happen first year, but redemption happened in 4th year. Redemption as in repayment. 4th year, if you are repaying financial liability, entry is financial liability to bank. ACM table will give you the value. That's all. Okay. Fair enough. Next question is on Ind AS 24 on the related party. Simple question. ABC, Mr. Okay, Mr. ABC have direct interest of 40%, 10%, 10% of trust T. So 3 individuals have 40, 10, 10 in one trust. Okay. Okay, if you add 40, 10, 10, it is 60. The remaining 40% interest in still is held by others. Some unrelated parties are holding this. This is the setup till now. Okay. Alright, Mr. ABC wished to control the trust and though enter into a contractual agreement to act together. Sir, if you just check, none of them have more than 50%. And so individually, nobody has control. But these 3 people have made a contractual agreement that they'll control this trust together. A contractual agreement will be a joint arrangement then, yes, no? Because there is a joint control happening here. They've agreed to act together. Okay. In this situation, assume that 1% interest constitutes 1 voting right. Okay, fine. S is a wholly owned subsidiary of P Limited and P is a wholly owned subsidiary of Trust. So this Trust, has control over one company called P Limited and P has control another company called S Limited. This is the structure is what they are given. Now, should the group of persons be disclosed as the ultimate controlling party where they have contractual agreement to act together? Sir, these 3 people have a contractually they have agreed to act together means they have a joint control. So they are able to control trust through trust has P means they'll be able to control P also. They'll be able to control S also. So when S Limited prepares financial statement, yes, they will have to show that Mr. A, B and C through the contractual agreement, they are the jointly controlling parties. That you need to tell. Okay. And T Limited is the ultimate parent entity because individual. No? So you have to give entity disclosure as well as the persons. So S will say these 3 persons through the joint venture is able to control and trust is our ultimate reporting entity. entity, it's a company, right? These three are not individuals. So that we need to disclose. So basically answer for this is yes. Okay, these three parties will have to be shown by the companies as the ultimate controlling party. Theory question, that's it. Okay. Question number 17, easy question on inventory. Entity manufactures an equipment in 3 stages. Goods are produced in 3 stages. Market value of semi-finished product for each stage. There is a market for semi-finished product for each stage. Even work in progress product has a market value, it seems. But the entity's practice is to sell only the completed equipment. We don't sell any work in progress. We sell only finished goods. Okay. Cost structure they've given. Sir, first stage mein we have already incurred 170 rupees cost we have incurred. Second stage mein we'll incur 35 more. So total will become 205 adding these two. Third stage mein we'll incur 62 more and it will become 267. Okay, then they've given selling price. At each stage mein what is the selling price? All you need to find out is, or they're saying assume selling cost is 0. You need to find out NRV of the semi-finished product at stage 1 and stage 2. Sir, how do you get net realizable value of the work in progress? Estimated sale value minus estimated selling cost minus further completion cost, if any, right? Further completion cost, if any. Estimated sale value. Sale value is of a finished product, right? When you sell, when it becomes a finished product, finally you'll sell it for how much? When it is work in progress, okay, when it is in stage 1, the selling price of this work in progress is 130 because after stage 3 is completed only, it will become finished product. At stage 1, the market price is 130. We don't need that. At stage 2, it is 195. After stage 3, it is 275. 275 is the final selling price of the finished product. Okay. So estimated sale value here refers to the sale value of the finished product, which is 275. Okay. Minus selling expense. They asked us to assume selling cost is 0. So minus 0. Now we have to find out NRV at various stage. If you are in stage 1, stage 2 ka 35 cost, stage 3 ka 62 cost not yet incurred. So this becomes your further completion cost. If you are in stage 1, these two costs 35 and 62 not yet incurred. That becomes your further completion cost. Reduce those. That is your further completion cost and you will get NRV. This is NRV for stage 1. Now if you are in stage 2, the final sale value of the finished product is 275. Selling cost is still 0. You are in stage 2 now. If you are in stage 2, right, 62 rupees of the stage 3 cost you have not yet incurred. You will incur in future. So that becomes your further completion cost. So reduce only 62. Okay, because at stage 2, 35 is already incurred. When you are in stage 2, only this cost is not yet incurred. So it becomes further completion cost. Reduce it, you will get 213. This is the NRV. And the valuation will be same. Cost or NRV, whichever is lower. Compare. Okay, and you will get first stage mein cost is 170, NRV is 178. Inventory will get valued at 170. Second stage mein total cost is 205, NRV is 213. Again, it will get valued at 205. That way. Okay, then 267 or 275, whichever is lower. Like that, they were not asked valuation, they only asked NRV determination. A very simple question. This all is the answer for this. Okay, fine. Question number 18. This is on borrowing cost. Easy question, but good framing. A company has borrowed 10 lakh rupees specifically to finance a construction of a head office. Since we have borrowed this loan specifically for construction, it's a specific borrowing. Okay. The loan was availed or taken on 1st May. Interest rate is 12%. Up till February, it is 12%. From 1st February onwards, it will become 13. From 12, the interest rate has become 13. Remember, the change of interest from 12 to 13 has happened on 1st February. Date is important. Owing to standard secured overnight financing rate, SOFR. LIBOR we have. Now LIBOR and all is replaced, I think, with SOFR. That's okay. It's not our headache. Construction of a building does not begin until December 1st. Sir, you might have taken a loan on 1st May, but construction starts only on December. Now we have conditions for borrowing cost capitalization, right? One, borrowing cost should be incurred. Borrowing cost starts from 1st May. Then expenditure on qualifying assets should have begun. Activities relating to qualifying assets also should have begun. So condition, since expenditure on qualifying asset is starting on 1st December, your borrowing cost starting date is also 1st December. Before 1st December, whatever borrowing cost or interest cost you have incurred, it will go off to SPL. So current year, how many months? December, January, February, March. Only 4 months borrowing cost you will capitalize. Balance borrowing cost you will transfer to SPL. Okay. It continues on 1st December and goes without interruption until after the year end on 31st March 2009. Construction is still going on, but year has ended. During the period of construction, an entity incurs directly attributable cost of 1 lakh in December. So December month may you have taken a loan, no? How much loan you took? 10 lakh. Out of that, 1 lakh we used in December. Okay, that's what they're saying. Okay. Now, if you want, I can just put up here loan used balance. This is in December May. Sir, loan was 10 lakh, but you used only 1 lakh. That means balance is 9 lakh. I'll tell you why am I doing this. Okay. Similarly, January May, you had 9 lakh. Again, you spent 2,50,000 each month from January to March. So in Jan, Feb, March, totally you are using 2.5 lakh. Okay, this much you have utilized. So in 9 lakh, 2.5 is utilized, so remaining is 6.5. Okay, so 6.5 may 2.5 you have utilized, so remaining is 4. In 4 may 2.5 you have utilized, so remaining is 1.5, like that. Okay, I'll tell you why I did this. Not required to be done in exam, just for one of the calculation, this becomes easy. Okay, that's how you have utilized the money. In December, January, February, March, May, it got utilized. Okay. Alright, for simplicity, assume that these amounts are spent on the first day of the month only. Great. Each month borrowing cost, each month borrowings less any amount that is expended for the building works in that month are reinvested and earn interest at the rate of 5% per annum. You remember, for specific borrowing, there is a concept called temporary investment income. See, here only, you have taken the loan on 1st May, right? You have taken the loan on 1st May, but utilization starts only in December. So from May to December, you already have this loan. Will you keep it idle? No, you will reinvest, right? So when you invest, right? When you invest that money, you will earn some temporary investment income. They are saying the income earns a return of 5% per annum. If you have idle money, you can utilize that money and earn a return of 5% per annum. This is your temporary investment income, which Ind AS 23 says. Borrowing cost relating to qualifying asset you can capitalize, but if there is any temporary investment income, that you need to reduce. Here we need to calculate that. They have not directly given. In all our problems, they used to give that directly. We earn 25,000 temporary investment income, 10,000 temporary investment income. Like that they used to call. Here it's not given. We need to calculate. That's one. Okay, for the year ended 20x1, X earned expensive, blah, blah, blah. They've given. Okay, so we need to recalculate that. You need to tell how much is the borrowing cost you will capitalize. All this data is for the whole year. We don't need all that. Okay, we can't take this data and do the capitalization because our capitalization period is only December to March. Because here, right? So we can't take this data. We'll have to rework it. How much borrowing cost to be capitalized? Very simple. First, borrowing, since it's a specific borrowing, right? Capitalization will start from December because construction started on December. Okay, how much? You took a loan of 10 lakh. Remember, loan ka interest rate is changing from 1st February. So December, January interest rate was 12 only. 10 lakh loan amount, 12%. Let's calculate the interest month by month for easy calculation. 10 lakh is a loan amount. Interest rate is 12% per annum. So for December 1 month, you'll do 1 by 12. This will be the borrowing cost for December. January, loan is still 10 lakh. Interest rate is 12%. For 1 month, 12% is per annum. For January month, interest rate is 1 by 12. If you do, you'll get 10,000 again. Now February, loan is still 10 lakh. But the interest rate is not 12. It has become, from 1st February, it has become 13. So now calculate for February and March, interest rate for 1 month at 13%. So this way you will get the total borrowing cost. Easy. Okay. Can you capitalize this? Yes. But if there is any temporary investment income, you need to reduce that. Okay. So they have given temporary investment income 37. Don't take that, sir. That is for the whole year. Whole year borrowing cost are you capitalizing? No. You're only capitalizing 4 months. Means only that 4 months ka whatever temporary investment income you have earned. Only that much you need to reduce. So entire amount you can't take. Hence I told this number we can't take. Okay, because we are not, see, total interest is 1,11667. Are we capitalizing 1,11667 or only 41,667? 41, because this is only for 4 months period. Same way, temporary investment also you need to calculate and reduce only for 4 months. Okay, for that you need how much balance is available, because you'll invest what, sir? Amount what, sir? Like here, December, May, you have loan of 10 lakh, but you utilized only 1 means how much surplus money is available with you? 9 lakh, right? You will need it in the next month. So this 9 lakh you will invest at what rate? 5% for 1 month, like this. So that for that amount, for calculating the temporary investment income, I just made this, or you can calculate directly also. So in December, May, though you took a loan of 10 lakh, though you took a loan of 10 lakh, you utilized only 1 lakh for building construction. So 9 lakh was pending. So you can invest that money at what rate? 5%. We'll calculate for each month. So 5% is the return for the whole year. They told 5% per annum. So for 1 month, how much? This is your temporary investment income for December, which we need to minus. So what about next? Sir, in 10 lakh mein, 1 lakh you utilized last December mein only. So that means you had 9 lakh. So come 1st January, you had 9 lakh loan with you. But you utilized on 1st January 2.5 lakh. That means money available with you what? 6 point. This 2.5 lakh rupees you have used on the beginning of the month. So 6 lakh 50,000 is the amount available with you. That's what I've done here. 9 lakh minus 2.5. Okay, how 9 lakh? 10 lakh minus 1 lakh is 9 lakh. So in this 9 lakh, 2.5 lakh got utilized. So balance is there. That balance you'll utilize, you'll invest for 1 month and earn a return of 5% from that. Like this. So 9 minus 2.5 will give you 6.5. Next month, from that 6.5, you have utilized 2.5. So 6.5 minus 2.5 is 4 lakh. At 4 lakh, you will invest for 1 month at 5% and earn this much income. Again, from 4 lakh, 2.5 got utilized in the next month. So 1.5 lakh money is still available idle, which you will invest and earn a return for 1 month. This is your temporary investment. This is the borrowing cost for 4 months. This is your temporary investment income for the same 4 months. This you can capitalize. This you need to adjust. Okay. So from this number, if you reduce all this, you will get the net borrowing cost to be capitalized. That's all is the whole funda of this question. Okay. So this is the net borrowing cost which will capitalize. Easy people. Good question. Simple but good one. Okay. Yeah, but don't take off. Many students will do a mistake of taking this full number. So this is for the whole year, right? We are not capitalizing whole year ka borrowing cost, but only 4 months. Hence, only 4 months related temporary investment income only you need to reduce. That's the main takeaway or learning from this particular question. 19th question is cash flow statement question. We have a similar one, so we don't have to worry about that. It's a repetitive question. The last question for this RTP, question number 20. There's also a repeat, but still, we'll do it off. A Limited exchanges car with a book value 13,000, and so we are exchanging car. So we are giving away car X whose book value is 13, fair value is 13,250. For cash 150 and car Y which has a fair value of 13,100. So this is an exchange scenario, right? Now people, we know the exchange provision, but whenever I told when exchange scenario happens, you first have a basic idea as to what asset is coming in and what asset is going out. In and out assets, make a track of it. Car X is going out. Okay, car X is going out. What is coming in? Two things are coming in. One cash, another is car Y. Car Y and cash are coming in. Car X is going out, right? So with this, you can finish off the journal entry. Whichever asset is going out, you need to de-recognize. So credit it. You'll have to credit car X. Whichever asset is coming in, you need to debit. So car Y you will debit, cash you will debit. So entry you can complete. This journal entry part you can complete first. Now, since car X you have to de-recognize, you have to cancel, it's gone out, you have to cancel it book value only. Whatever value you are showing in your books, you need to cancel that. So you'll credit car X by 13,000. That portion is complete. Okay. Now let's go through the remaining. Car X ka fair value also they have given, car Y ka fair value also they have given. Done. But the transaction lacks commercial substance is what they are saying. Sir, people, I told you the provision. Whenever this exchange scenario happens, as a thumb rule, we have to use fair value. But under two circumstances, fair value is not used. One, when the transaction lacks commercial substance, or a fair value of the asset coming in and going out. Both those assets ka fair value you cannot find out. Here, asset ka fair value you can find out. So that scenario is not applicable. But which is applicable? Transaction lacking commercial substance. What does transaction lacking commercial substance mean? Sir, transaction lacking commercial substance means due to this exchange transaction, cash flow is not changing. How much ever cash flow you used to get, the risk, timing and amount of cash flow, what you used to get from car X, same now you'll get it from car Y also. I mean, by doing this exchange, you are not earning any extra cash flows. If you are not earning any extra cash flows, we say transaction lacks commercial substance because entities' cash flows are not expected to change. Okay. Now, if transaction lacks commercial substance, we will use book value. Okay. Or in simple terms, basically, or another simple things. Sir, if transaction lacks commercial substance, that means touch your heart and tell. Whether now you are using car, after exchange you are using car Y. Now you are using car X. After this exchange you will use car Y. Whether you use car X or whether you use car Y, right? Will the cash flow change? No. That means whenever transaction lacks commercial substance, gain or loss should not be accounted. Gain or loss should not be booked. Whenever you're using fair value, you will book some gain or loss. But whenever transaction lacks commercial substance, no gain or loss to be accounted. So this you'll derecognize at carrying amount. Now cash, how much did you get? 150. So debit cash by 150. Car, why you debit as a balancing figure. That's all. 13,000 by 150 if you reduce, you'll get 12,850. This way, you'll not get any gain or loss. If you are using fair value, you will get some balancing figure. That will be the gain or loss on exchange, which will be transferred to SPL. Okay, that we have done. Such question we have done. I think this one we had, I don't remember. Maybe it was done. I don't remember. Yeah. But anyways, now it's in which way covered. Okay. Yeah, that's with respect to the accounting. And with this, all the RTP questions we are done for. Okay. So wish you all the very best for exam. Take care. Give your best.